Are you ready for an eye-opening lesson on investing? If so, you don't want to miss out on valuable insights into the mistakes investors make. The power of long-term compounding, and the impact of share repurchases. Watch till the end and learn from the wisdom of one of the world's greatest investors, Warren Buffett, and discover how to apply his strategies to your own portfolio. So sit back, relax, and prepare to be inspired. Lesson 1: Investing Mistakes and the Creative Destruction of Capitalism. In his annual letter to shareholders, Warren Buffett emphasizes the importance of being a business picker rather than just a stock picker. He stresses the need to focus on the fundamentals of a business, such as its management, competitive advantages, and long-term prospects. This approach differs from that of many investors who focus primarily on the price of a stock, trying to time the market or chase short-term gains. Buffett also acknowledges the mistakes he has made over the years, such as investing in companies that ultimately failed. He notes that while these mistakes were painful at the time, they have provided valuable lessons that have helped him become a better investor. One of the most important lessons he has learned is the concept of creative destruction in capitalism. Creative destruction refers to the process by which new technologies, products, and companies emerge and displace older, less efficient ones. While this process can be painful for those involved, it ultimately leads to a more efficient and dynamic economy. In the long run, creative destruction is a positive force that drives innovation and growth. However, for investors, the process of creative destruction can be tricky. As companies come and go, it can be difficult to identify which ones are likely to succeed in the long term. Buffett notes that one of the keys to successful investing is to focus on companies that have a competitive advantage, such as a strong brand, a unique product, or a loyal customer base. These companies are more likely to survive the ups and downs of the market and emerge as winners in the long run. Buffett also provides a report card of his own capital allocation decisions over the years. He notes that while some of his decisions have been successful, others have been less so. For example, he acknowledges that his investment in the textile industry was a mistake, as it was ultimately displaced by more efficient competitors. However, he notes that he has learned from these mistakes and has become more disciplined in his investment approach over time. Lesson 2: The Long-Term Compounding of Winners. Lesson 2 of Warren Buffett's annual letter to shareholders emphasizes the importance of investing in businesses with long-term winning prospects. He explains that investing in such businesses, even if they make mistakes along the way, can lead to significant long-term growth. Buffett highlights Coca-Cola and American Express as prime examples of such businesses. Buffett explains that the compounding of returns over a long period of time can lead to significant growth in an investor's portfolio. He believes that investors should not focus on short-term market fluctuations or the quarterly earnings of a company. Instead, they should focus on the long-term potential of the company's business model and its competitive advantages. By investing in businesses with sustainable competitive advantages, investors can earn a significant return on their investment over a long period of time. Buffett highlights Coca-Cola as an example of a business that has consistently delivered strong returns to shareholders over a long period of time. He explains that despite the fact that Coca-Cola has made mistakes along the way, the company's strong brand, distribution network, and customer loyalty have enabled it to remain a dominant player in the beverage industry. As a result, Coca-Cola has been able to generate significant profits for its shareholders over the years. Another example of a long-term winning business that Buffett highlights is American Express. He explains that American Express has built a strong brand and a loyal customer base over the years, which has enabled it to weather economic downturns and deliver consistent returns to shareholders. Buffett points out that American Express has faced challenges in the past, such as the loss of its Costco partnership, but the company's strong competitive position has allowed it to bounce back and continue to grow. Buffett also emphasizes the importance of starting early and living into your 90s when it comes to investing. He explains that the longer an investor can stay invested in a winning business, the greater their returns will be. He encourages investors to adopt a long-term perspective and to avoid getting caught up in short-term market fluctuations. By staying invested in a winning business over a long period of time, investors can benefit from the compounding of returns and earn significant wealth. Lesson 3: The Impact of Share Repurchases. Share repurchases, also known as stock buybacks, are a common way for companies to return value to their shareholders. When a company repurchases its own shares, it reduces the number of outstanding shares, which increases the value of the remaining shares. This can be a valuable tool for companies to use when they believe that their shares are undervalued in the market. In Lesson 3 of Warren Buffett's annual letter to Berkshire Hathaway shareholders, he discusses the impact of share repurchases on Berkshire and other public stocks they own. According to Buffett, share repurchases can be a smart use of excess capital, as long as the company's shares are trading below their intrinsic value. However, Buffett warns that companies should not use share repurchases as a substitute for investing in the business or pursuing strategic acquisitions. Buffett goes on to explain that Berkshire Hathaway is a big fan of share repurchases, and has repurchased more than $24.7 billion worth of its own stock since the end of 2018. He believes that the company's shares are trading below their intrinsic value, and that share repurchases are the best way to return excess capital to shareholders. In addition to discussing Berkshire Hathaway share repurchases, Buffett also takes a jab at politicians who want to limit the practice. He argues that share repurchases are an important tool for companies to use, and that they benefit shareholders by returning value to them in the form of higher stock prices. Buffett believes that attempts to limit share repurchases are misguided, and that they would harm investors by reducing the amount of capital that companies can return to them. Buffett also notes that share repurchases are not the same as dividends. While dividends provide investors with regular income, share repurchases increase the value of the remaining shares, but do not provide any immediate income. However, over the long term, share repurchases can be an effective way for companies to create value for shareholders. To illustrate the impact of share repurchases, Buffett uses the example of two of Berkshire Hathaway's long-term holdings, CocaCola and American Express. Both companies have repurchased a significant amount of their own shares over the years, which has helped to boost their share prices and increase the value of Berkshire's holdings. In the case of Coca-Cola, Buffett notes that the company has repurchased more than $21 billion worth of its own shares since 2010, and that Berkshire's stake in the company has increased from 200 million shares to over 400 million shares over the same period. This has helped to drive up the value of Berkshire's holdings in Coca-Cola, and has allowed the company to generate significant returns for its shareholders. Similarly, American Express has repurchased more than 40% of its outstanding shares since 2000, which has helped to boost the value of Berkshire's stake in the company. According to Buffett, American Express is a prime example of a company that has used share repurchases to create significant value for its shareholders over the long term. Thank you for watching. If you enjoyed this video, please make sure to like, subscribe, and click the notification bell so you don't miss any of our new videos. See you next time.